Hello smart money traders, welcome back to the channel. In this video I want to show you the easiest approach to trading synthetic indices with ICT concept. There is something you need to understand whenever you're trading synthetic indices. You don't really need too much data, and that is why I've just listed some few things you need to understand in order to be able to trade synthetic indices. I'm going to show you how I literally trade synthetic indices with the ICT concept. Now what I focus on is mostly order flow and then liquidity, and I'll also focus on institutional reference points and then my entry. These are the very basic things you need to know. I'm not going to go into explaining these things in detail because I've already made the first video in this particular playlist. Simply come to my YouTube channel, go to playlist and check ICT for Volatility Index. You're going to find that video right there. So let's get back to that, and I'll show you the exact method I use whenever I'm trading. The first thing is to actually look for order flow. As I've told you earlier, the order flow is to actually know where the money is going. That's basically what order flow means, where the price is going to or where the institutions are taking price. So that's the first thing you need to understand. And understanding order flow is pretty much easy. Whenever I'm trading synthetic indices, I just use the daily time frame as my highest level for checking order flow. Once I see it like this, you can literally see from here that this is a bullish order flow, and from here we're having a bearish order flow. We're going to work with the most recent data right here. What I have right here is what I'm going to show you my approach, because this is Volatility Index 100. You can use it on any synthetic indices. So looking at what is happening right here, this is a bearish order flow, and that is the first thing you need to understand. And the second thing you need to understand is where liquidity is, because the market moves in two patterns. It grabs external range liquidity and then comes back to an internal range liquidity. External range liquidity are liquidity that are residing in form of buy stops and sell stops. I have explained that in detail in some of my videos. You can check them right there. So let's take, for example, I want to trade this particular asset now, and I'm focusing on the data right here. Okay, I'm just focusing on the data that is right here. I'm just going to show you straight away. Right here, from here you can see price has been coming, and here we have a break of structure right here. This is a break of structure. Every one of you can see this is the very basic of ICT concept. And after this break of structure, what do you look out for? Now you look out for price to come back to an internal range liquidity, because we have two types of liquidity. The liquidity that was taken outside this range, let's say this particular range from here to here. Okay, the liquidity that was taken outside it is called external range liquidity. Now price will always come back to an internal range liquidity, but ultimately we are seeing this relative equal low, or what we call a rejection block at this level. This is a rejection block. Price is trying to come to this particular rejection block. So assuming we are looking at this particular data alone, we want to take price to this level. Ultimately this is our POI, point of interest. Now at this particular level, we've taken external range liquidity. We're expecting price to come back to an internal range liquidity. Now what do we see here? As price is coming back, we can see an order block right here. Okay, this is from the daily time frame. You have to do this from the higher time frame, then you go down to the lower time frame, because that's the best way to approach it. It's called top-down analysis. Okay, so once you are able to mark out your POI, this particular rejection block and then this order block, as price takes this, ultimately we are reaching here, but we need to see the rhythm of the market going external, internal, external, internal, external, internal, until when it reaches this rejection block. So right here we have taken external range liquidity. Right here we are coming back to an internal range liquidity. So this is our focus now, this retracement. Let me change the color so you can see it properly. This retracement is literally our focus. We are not going to focus on anything apart from this particular retracement. Okay, this retracement. Now we drop down to a time frame lower. Let's go to 4-hour time frame and still see what that retracement looks like. We are seeing this retracement coming into this particular order block. This is MT5. I don't have the luxury to do a lot of drawings, so this is our retracement. Let me take it out so you can see what I'm saying. Our retracement is literally seen by everybody here, this retracement. So we know that price is ultimately coming to that daily order block, but this retracement will take time before it reaches there. You are not trading the daily time frame. So we are seeing this coming back to that point of interest as price starts going back from here. Since we see this bearish candle being taken out by the body of the bullish candle, we have engulfed it. We are now expecting price to come back to an internal range liquidity, at least 50% of your Fibonacci retracement tool. at least 50%. Okay, as price is coming back, we want to see it come at least, I wish this can give me what I'm looking for, at least 50%. Yes, I've gotten it. As price is coming back, we need to go above 50% since we want to go for the sell. It's called premium. Below it is called discount. This is from my video on PD-ARRAY. Below your 50% level is called discount. Above it is called premium. So if you are in a bearish market condition, you will sell from premium and then you will buy from discount. So price is currently at premium. This is the perfect way to approach this. So from here now, we can say that we can confidently take our trade for the sell, but we're not going to take it blindly right here. From the daily time frame, we cannot be patient. This is 1, 2, 3, 4 days. Now we'll go down to the 4 hour. This is the rationale behind going down to the 4 hour time frame, and this is the data that we have here. Remember that our break of structure that happened right here. As price is coming back now from this entire data, we can also go down to the 1 hour time frame and have a better look at that entire retracement. You see what I'm saying now? So this is the retracement that we saw from that particular daily time frame, and then we drop down to the 4 hour time frame. We saw it a bit chunky, but now we can literally see it as a very good uptrend. And then this color, this above color, is our daily time frame point of interest. Now we can trade this as a bullish order flow until we reach this level. Okay, so this is the rationale behind trading synthetic indices. So from here you can look at this high. Once price takes out this high, you've seen this market turning into a bullish order flow. So as price takes this out, comes back into this area, takes this up, comes back into this area, takes this up, comes back into this area, takes this up, comes back into this area. Now you can be trading these bullish order flow. So how do we trade it? Let's take, for example, any of these, right? Let's take, for example, this place. As price came up to this area, as soon as we have broken structure right above here, okay, we see this retracement coming into this place. We take our Fibonacci tool and measure it. Let's have at least 50% of that particular movement. Okay, let's have the retracement reach at least 50% level of our Fibonacci tool. Yes, now we can see that we have a confident trade to take. As price move from here to here, as price comes back to this place, 50% is okay, at least below 50%, right? Now from here we can further go down to the lower time frame. We're not just going to take it blindly, because sometimes price can even reach to this particular order block or the above fair value gap, this fair value gap. Let me show you the fair value gap, this one. All these terms are ICT terms. I know most of you are ICT students, so I'm not going to go into explaining this. This is a fair value gap, right, guys? So as price is coming back, we are not sure whether it will reach this fair value gap or this order block. So that is why we need to go to the lower time frame. Let's say 5 minutes. So if you drop down to 5 minutes, you're going to have the perfect trade entry, guys, from that place. So this is how the 5 minute time frame looks like. You can see, even though this is a bit noisy, look at it. As price was coming down, look at what happened. We have a complete shift in market direction here. From that retracement down, as soon as you see this, you should know that price is no longer going to continue downward. So this is your entry from this point. Let me delete this, guys. As soon as price takes out this high and then it came back into this fair value gap, look at it. This is a simple way to trade this, guys, and synthetic indices always use this simple approach. So as soon as price came back into this fair value gap, guys, this is your entry. At this point, you're going to have an entry that is a bit encouraging. So let's go and change the color to green. Okay, so this is your entry, guys, and your stop loss is obviously right below here, below this level. That is how you go about trading synthetic indices. It's pretty much easy to trade it with this ICT concept. So this is your entry, guys. As soon as price comes back to this fair value gap, you take your trade from there. And I hope every one of you understood what I just explained right there. Going back to the 1 hour time frame to still look out for that area. Can you see the area I took that trade from here to right above here? Now let's look at another one again and see how we can get an entry right there. Close to this place, we have this movement. Close to that particular place, This MT5 is not giving me exactly the kind of drawing I'm looking at. So this is it. We have a break of structure. Remember, once you reach this place, or once you see this bullish movement turning into a bearish movement, you're not going to take the buy again. This is because you're reducing your data from daily time frame to the 1 hour time frame. Ultimately, from the daily time frame, you are bearish. Remember, you are bearish, but this retracement will take time, almost 6 days. We can trade as a bullish movement since we see this last red candle being taken out from here, just like this one. Can you see this last red candle being taken out? So we can trade this retracement into this order block as our point of interest. This order block is now our point of interest if you're trading that. I hope you are getting everything I'm explaining in this video. So as price comes back, this is 1, 2, 3, 4, 5, 6 days. 6 days is too much. We can go down to the lower time frame and take our trades from there. So this is the same thing I showed you right here. So when you drop to the 4 hour time frame, you're not seeing it clearly right here. Where is it? I'm not seeing it clearly, and that is why I drop down to the 1 hour time frame so I can see this clear movement. So let's look at this entry right here, either this one, once we see a break of structure and another break of structure right here, synthetic indices. So let's start from this. So we know that price may approach this bullish order block, and then right here there is a fair value gap right inside of it. Fair value gap here. Okay, right here, fair value gap is right inside this. So as price is coming back, let's see where price is at currently from here to here. Are we below 50%? Yes, it's okay to take the buy. So now, do we just blindly take the buy? No, we now drop down to the lower time frame. The same thing that happened right there. Let's look at this area, go down to the 5-minute time frame. So this is exactly what we have in the 5-minute time frame. Let me bring it closer so you can see. This is the 5-minute time frame, guys. So as price is retracing, you are looking at what is happening. You can see this break of structure create this low. So once we created this low, we have pushed up and created this high. So this is no longer our high, this is our recent high. So we mark out this high. Anytime we see price push above this high, we can confidently say that we have changed market direction. So we are not taking trade blindly from here. So we will focus on this high. As price takes out this high, you can see price have actually taken out this high right here. Taking out this high, and it is coming back into what? A fair value gap or an order block right here. So this is your entry, guys, as price comes back to this order block, and that is your entry from the lower time frame. Let's give it a movement and see to this level, that entire movement, and then let's see our stop loss just right below it, that entire movement. Let me change the color so you can see this as a real entry. Okay, so that is the entry, and then this is the stop loss. I'm finding real difficulty in getting this with MT5, but I hope you can also do the same. So this is your entry, guys. As price comes back to this, there is a small fair value gap right here, and then this bullish order block. That's your entry, guys, with synthetic indices in the 5-minute time frame. And I hope this video is really helpful for you to understand what I'm saying. So as soon as you reach that level, once you reach here, can you see the higher time frame point of interest? Once you reach that place, you are not going to take trades again as a bullish market, because now the bigger time frame is going to act. As soon as it reaches that place, look at how they aggressively changed the direction of the market, and they took out this. So instead of waiting for price to come back to this place in the higher time frame, to this order block in the daily time frame, it takes almost 5 days. You can confidently trade this retracement. This is what we call counter trading, and I do this a lot with synthetic indices. Okay, as price comes back here, the same thing with this. As you see this break of structure, this retracement can be traded. This break of structure, this retracement can be traded. So this is all about this simple approach that I use for trading synthetic indices, guys. If you have any question, let me know in the comments, and I'll be there to answer you. Thank you for watching, guys. I will make the last video, and after that I will stop making videos on synthetic indices until another time when I see a working approach in the synthetic indices. Thank you guys. Make sure you subscribe to the channel. See you in another video.